Contagion risk refers to the danger that economic distress or collapse in one company, sector, or market segment rapidly spreads to others. It essentially describes a domino effect where panic or negative sentiment is transmitted across seemingly unrelated assets. For instance, if a major Indian NBFC defaults, investors might suddenly lose confidence in the entire NBFC sector, forcing widespread selling. This panic can quickly cross over to other financial entities like banks, which have lending exposure to the troubled sector. The risk is magnified in an interconnected market like India's, where FII sentiment often treats the entire country as one investment class. A sudden, sharp FII outflow triggered by a global event like a US rate hike can cause liquidity issues across all Indian indices, regardless of the fundamental of individual Indian companies. Furthermore, if a large diversified conglomerate faces a crisis, its troubles can infect its suppliers, vendors, and lending banks, spreading the distress across multiple sectors. This selling pressure forces margin calls, leading to a further liquidation of unrelated assets to cover losses, creating a vicious downward cycle. The lack of adequate regulatory oversight or transparency in smaller market segments like certain small cap or micro cap sectors can also act as an entry point for localized panic that spreads broadly. Managing contagion risk is paramount for the RBI and SEBI to maintain financial stability in Indian share market.